Hello everyone. Today we looking back at my experiment of investing crypto Solana, and today is the price is 95. When we bought it were 82, and now we make like $5,500 gain, and I sold. I think yesterday or today actually I sold about 100 share, and then I realized $1,000 profit, $1,000 gain, but now we still have about $5,000 gain. So maybe the next sale, maybe if it go to about 105 or so, I can sell some more. But now I'm gonna just watching, and I sell it so I can have money if I need to buy some more later. And the prediction at the end of the month, this month will be 102, next month 105, and the end of the year 110. Because my prediction is conservative, because currency market it like $100 plus only 48% chance, and 90 plus 55% chance. So I'm really conservative on that one for now. And the market cap of Solana is $55 billion right now. So this is really good week for cryptocurrency. And Solana, it went from 75 to 100, and now come back to 94. Ethereum, the same thing. For 1 week it went from 1,892 to 2,500, and now 2,451. Bitcoin, the same thing. It went from 63,000 to 78,000, and now 77,400. And the stock market, today the stock market still closed. S&P 500, Dow Jones, they all still closed. The gold market already start back up. I think the Asian market already starts trading gold, and we see a little bit down but not much. The same thing, oil start trading already, and also a little bit down but not much. SpaceX, the market still closed, and the bond market already open, maybe in Asia. And we see the bond market is the interest rate is coming back down. That's good news. 30-year mortgage down about 1.5 base point. 10-year about 1.3 base point. And 1 month T-bill is the same. 1 year yield about 0.6 base point. So according to the interest rate, look like it's doing really pretty good so far. And see what a more detailed market briefing for Sunday evening, August 23, 2026. Focusing on what could move your portfolio when the market reopen. Iran sanctions are the biggest short-term risk. Treasury Secretary Scott Bessent is expected to announce new sanctions on Iran Monday at 2 p.m. Eastern Time, despite describing them as the toughest the toughest sanctions in the history. Iran rejected the threat, while Pakistan is also trying to mediate between Washington and Tehran. Financial issue is oil. Iran's disruption of the Strait of Hormuz have already constrained global energy flows. If Monday's sanctions target countries buying Iran oil, especially large trading partners, the market could interpret them as another threat to global crude supply. Market impact: higher oil could likely push inflation expectations and treasury yields higher, which would be negative for technology stocks. A diplomatic breakthrough would likely do the opposite. Interestingly, Brent crude have initially moved lower about 93.45, while WTI fell about 86.14 as traders look profit ahead. Monday's announcement level I could watch. Brent above 100 would be an important warning. A sustained move back below roughly $90 would reduce some inflation fear. The Treasury bond market remained the highest structural threat. The recent sell-off in U.S. government debt drove the 30-year Treasury yield as high as 5.337%, the highest levels in 2007. That matters because Treasury yield act like basic price of money for the entire U.S. economy. When the yields rise, mortgage rate rise, corporate borrowing become more expensive, leverage investment become less attractive, stock valuation come under pressure. Technology stocks are particularly vulnerable because investors value large position of their expected profit many years into the future. Treasury Secretary Scott Bessent responded by double certain long-duration Treasury buyback to at least $4 billion per operation. The 30-year yield initially dropped sharply around 5.19%, but the intervention did not eliminate concerns about inflation, deficit, and federal borrowing. This is the indicator I would watch most closely. If the 10-year Treasury approached 5%, I would become considerably more cautious about high valuation growth stock. Nvidia earnings could move the entire stock market Wednesday. Nvidia reports second quarter result on August 26th. This isn't just another corporate earnings report. Nvidia become a proxy for entire AI investment cycle. Philadelphia's semiconductor index dropped roughly 5% last week, in part because rising long-term interest rates are making enormous AI infrastructure projects more expensive to finance. Nvidia and 6 major financial institutions are targeting more than $500 billion of AI Structured financing, showing how capital intensive and AI boom have become. Investors will therefore be looking beyond earnings per share. The important questions are hyperscalers still buying GPU aggressively? Is data center revenue continue to accelerate? Are customers delaying projects because financing costs are rising? Does NVIDIA raise or lower forward guidance? A strong bid plus high guidance could pull NVIDIA semiconductors and Nasdaq higher. But if guidance disappoints while Treasury yields remain near current levels, the downside could be substantial because AI valuation already assume very strong future growth. Jackson Hole is the week's most important macro event. Fed Chair Kevin Walsh will make his first major Jackson Hole appearance as the chairman this week. Investors are trying to determine whether Federal Reserve believes oil-driven inflation requires another interest rate increase. Market recently priced approximately 35% probability of September hike and 66% probability of at least one additional hike by December. That is a major shift from the rate cut narrative market had earlier. Walsh therefore faces a difficult balancing act. If he sounds hawkish, Treasury yield could rise and the technology stock would sell off. If he suggests the Fed can wait and assess incoming inflation data, yield could decline and risk asset could rally. This is why NVIDIA and Jackson Hole together make the coming week unusually important. Oil is transmitting geopolitical risk and directly into inflation. Brent finished Friday at $94 per barrel and Gulf stock market rose Sunday partially because stronger crude price benefit energy producing economy. Saudi Arabia's benchmark climbed 1.1%. Strait of Hormuz remain critical because historically a substantial share of global oil trade moved through the narrow waterway. Its supply disruptions intensify the effects spread throughout the economy. Oil lead to gasoline, lead to transportation, lead to manufacturing, food, consumer inflation. That's why oil isn't merely an energy sector story. It is influencing the Federal Reserve's next interest rate decision. The current 93 to 94 Brent level is uncomfortable but manageable. I would become more concerned about 100 and considerably more concerned around 110 plus. 6. Stock recovered Friday, but last week exposed to a vulnerability. A major index rallied Friday, but still finished the week lower. The semiconductor sector was among the weakest part of the market because investors simultaneously confront higher yield and question about the economy of AI infrastructure. The important point is that this does not yet look primarily like an earning recession. It looks more like a repricing problem. Corporation profit can remain strong while stock decline if the interest rate investors use to value those profits rise substantially. That's why Treasury yield have become almost as important as earnings. Wall Street remains surprisingly bullish underneath the volatility. The UBS Global Wealth Management recently increased its year-end S&P 500 target to 8,100. That tells us institutional strategists haven't abandoned the bullish market thesis. Bullish argument is essentially corporate earning growth plus AI productivity, resilient economic activity. Stock can continue rising, but the bearish argument has strengthened. High bond yield, expensive valuation, oil-driven inflation, geopolitical instability equal potential correction. This creates a market where good earnings may still generate rally, but investors are increasingly sensitive to macroeconomic shocks. Gold rally is sending an important signal. Gold reached a 3-month high Friday and posted its third consecutive weekly gain. Gold rising while Treasury market concerns are increasingly suggest investors searching for protection against several risks at once. Inflation, geopolitical instability, fiscal deficit, dollar weakness doesn't automatically mean stocks are about to crash. But when gold, oil, and long-term Treasury yield all rise simultaneously, I pay attention because it can indicate that investors are demanding compensation for inflation and fiscal risk. The biggest issue may ultimately be government borrowing. Treasury decision to increase bond buyback have liquidity, but investors quickly return their attention to the underlying issue. Should borrowing requirements? Reuters reported the Treasury intervention only briefly eased the bond route because investors still worry about inflation and debt sustainability. This matters because the government must complete the businesses and households for capital. This matters because the government must compete with business and households for capital. Its investors require increasingly high yields to finance U.S. deficit. Those yields spread throughout the economy. They're potentially a longer lasting problem than any individual Fed meeting. This week could determine the market's direction in September. Key events unusually concentrate. Monday, Iran sanctions announcement. Wednesday, Nvidia earnings. Later in the week, Jackson Hole and important inflation economy data. The combination means market could move considerably considerably in either direction. My current framework is signal bullish and bearish. 10-year Treasury falling toward 4.5, bearish moving toward 5%. Brent crude below $90 or above $100. Nvidia bid and plus strong guidance, weak guidance. The Fed patient neutral or bearish is signal more hike. Iran diplomacy improves, sanction escalation, gold stabilize, accelerating sharply. My overall view tonight, I would describe the market as cautiously bullish but increasingly fragile. Corporation earnings and AI stories still support stocks, but the market now faces an unusual combination of high treasury yield and expensive technology valuation, elevated oil and geopolitical risk. If I had to choose just three numbers to watch Monday, they would be 10-year Treasury yield, Brent crude oil, and Nasdaq future. If the yield and oil both fell, that would be the meaningful bullish signal. If both rise sharply together, I would treat that as an important bearish warning for the stock, particularly technology and crypto. Alright everyone, today I think that's all today, and the good news is our portfolio is making money. It's not in the red anymore, and we'll see again. I'll see you again tomorrow in the next episode. Thank you very much. Bye bye.